Let's have a look at the moving average indicator. We're going to add it to the screen and I'll talk you through how the whole process works as we do it. First thing you want to do is make sure that you have your favorite blank template loaded up, like I do in front right here. Then we go on over to the Add Indicator button, or Indicators List as they call it. We click on that. And then if you move down under Trend, you should find Moving Average. Just select that. Now by default it will load up here. I believe the default period is 14. I'm going to set it to 10 just so it's easier to explain. Now all indicators in Forex have a period that you have to set. This is how much history is it going to be looking at to calculate the current result. When we set a period of 10, it means it is going to look at the current candle as well as the previous 9. So 1 being the current plus 9 is 10. What a moving average is, if we leave it as a simple moving average, it's going to take the 10 candles that we just discussed, and it's going to take all of the closing prices, if you have applied to close set, and it's simply going to divide it by 10. So it's going to show us the average closing price of 10 candles. Let me go ahead and add that so you can see. So a simple 10 moving average will generally follow the market relatively closely. You see these big spikes are kind of picked up as a small increase here, because at this point here, that may be the closing price, but it's taking 10 candles into account and it's giving you an average. Here, I'll put in a vertical line so we can use that as an example. So at this exact point, where the moving average has moved up, it's giving us a value of 1.13480. That means this candle and the previous 10 candles, the average closing price is 1.13480. This is a very quick and easy way to see the general trend in a market. I'm going to get rid of this vertical line. If you remember, we just double click, make sure the boxes are there and hit delete. I'm going to add another moving average and then we'll discuss the differences between them. I'm going to leave this as a simple moving average, but I'm going to increase the period. This one I'm going to set to 20. I'll change the color. So now we're going to have a blue moving average looking at 20 candles. You should immediately see that there is a big difference. And the biggest difference is that because we're looking at 20 candles, this one takes a little bit longer to respond. So while the 10 moving average, we can look at this section as a clear example, the 10 moving average has responded to the drop in the market, the small dip, as well as the increase. Whereas the 20, it barely even notices that, because it is taking 20 candles into consideration. All indicators in Forex do this. They look at a period, and that is how the current rate is calculated. Now, with every decision that you make in Forex trading, especially when adding an indicator and looking at the period, you need to consider the pros and the cons. With the moving average, the pros of having a faster moving average means that it responds quicker and therefore you can get into the trade earlier. The con is that a faster period will also mean that it will respond to these small little dips and spikes and tell you that the market is turning, so it's also less reliable. The pro of using a larger period is that it doesn't pick up all these tiny little movements, which makes it more reliable. It means it's following the trend a lot better. The con is that because it's more delayed, you generally enter the trades quite late, and this means you could miss out on a lot of trades, and also trades that you could enter, you're going to enter a bit late and not make as much profit as you could. So it becomes a bit of a balancing act, deciding how aggressive you want to be and how safe you want to be. Now if you want to remove an indicator, there's a couple different ways you can do it. You can either go to Charts at the top, select Indicators List, and then choose the indicator from the list. The most recent one is always at the bottom. So we added the 20 later, so this one would be the 20. I can select it and click Delete. The other way is to press Ctrl I to get the same list. And a third way is you can hover the mouse over it, then right click and delete indicator. I'm going to delete this one now. So remember, a simple moving average, the level that it's showing on the chart, is quite simply the average closing price over the last X amount of candles, and X is the period that you have set. Let me add another moving average. This time we will keep 10 period, but we're going to make it an exponential moving average. So we go back to indicators list. Now that we've used moving average recently, it's bubbled to the top up here. I'm going to set this one to 10. I'm going to change the moving average method to exponential. Leave it as apply to close and click OK. The main difference between a simple moving average and an exponential moving average is that an exponential moving average makes the more recent candles as more important than the ones further back. So even though both of these have a period of 10, they're both looking at the current candle and the previous 9, the exponential moving average is saying that the current candle and the very recent ones are more important, and therefore we will weight them more than the ones at the very end, being candles number 9 and 10. We find that an exponential moving average will respond quicker to the market, even though we're using the same period. And you can see here clearly in this run. You'll see that the 10 moving average, the simple being the red one, is actually quite smooth on this run heading up, whereas the exponential has responded a lot quicker. You see how we have this red dip that comes down. The red moving average barely notices it, but the blue one has actually dropped and crossed over underneath the red one, and then picks up again with this blue candle. So once again, we have to look at the pros and cons. It's the same idea as using a faster moving average, being using a smaller period, and we have the same pros and cons. It responds quicker, so we can get into the trade earlier, but it also means that it picks up a lot of these little fake signals, so we could be wrong more often. A very popular Forex trading strategy idea is called a crossover system, and the strategy that we're working towards is based off a crossover system. So let's run through it now quickly. I'm going to take our second moving average, I'm going to edit it, and set it to a period of 20. I'll leave it as exponential. Now I'm going to edit the first one, leave it as 10, and set this to exponential, and click OK. So now we have the red moving average has a period of 10 and it's exponential. The blue moving average has a period of 20 and is also an exponential moving average. We can use this as a possible trigger to look at entering a trade. I'm going to scroll back a little bit. What we're looking for in a moving average crossover system is we're looking for the points where two moving averages have crossed over. For example, right here, we see that the 10 has crossed over the blue in a downwards direction. This would be a trigger telling us it's time to consider a sell. And you can see how it has come down. When we see the red crossing above the blue, it's telling us this is a position where we might want to buy. And we can see that it actually worked out quite nicely. At this dip over here, this is the Brexit that just recently happened. We can see that the moving average crossed below the blue, and it's telling us this is a pretty good time to sell. And this trade alone would have been massive. 390 pips off of that. We can see here that the red has crossed above the blue, and it's telling us time to buy. That in short is what a crossover system is we always expect the Forex market to have highs and lows, but generally follow a trend. With two moving averages, it's telling us where is this new high, where is this new low, and we're kind of following it like steps moving up. A good Forex system is not just simply a trigger telling you when to buy or sell, but also where to put your stop loss, where to put your take profit. We will cover that later in the course. This is just the simple idea behind what we're doing, and hopefully to explain how moving averages work a bit more.